I want you to just close your eyes for a second. Picture yourself in a room.
Okay.
And it's not a comfortable room. It's freezing cold trading floors. They're always kept at refrigerator temperatures to keep the computers from overheating. And the hum of the servers is this constant low-level thrum in your ears. You're sitting in a chair that probably costs more than your first car, staring at a bank of what, 6 monitors?
That's the standard setup, yeah. For a fixed income portfolio manager, that's home.
Exactly. And on that center screen, you have your responsibility. Let's just say it's a portfolio of corporate bonds, high-quality investment-grade stuff. And the total face value was $100 million.
$100 million. That's the number you live and die by.
It is. So it's a quiet Tuesday morning. You're thinking about lunch. You're thinking about the weekend. And then in the bottom right corner of your peripheral vision, a little red number just blinks.
The 10-year Treasury yield.
It ticks up. Just a little bit at first, maybe 5 basis points, then 10. Then it hits 20. And it doesn't really seem like a crash. The stock market isn't screaming or anything.
No alarms are going off.
No.
Ugh.
But you look back at your center screen at that $100 million, and you realize something terrifying. The number is dropping, and it's dropping fast. By the time you've even processed what's happening, the value of that portfolio has hemorrhaged hundreds of thousands, maybe even millions of dollars.
And the worst part is, you didn't make a mistake in the traditional sense. I mean, none of the companies you lent money to went bankrupt. They're all healthy. They're all paying their coupons.
That's the kicker. That's what's so maddening. The companies are fine, but the value of your asset is just gone. It's like an invisible thief walked right past security, sat down at your desk, and just siphoned off your entire year's performance bonus while you were watching.
That thief has a name. In our world, we call it duration risk. And frankly, if you are holding fixed income assets, I don't care if it's $100 or $100 billion, and you don't understand how this thief operates, you aren't really investing. You're gambling on the mood of the Federal Reserve.
Which brings us to the mission for today's deep dive. We are going to stop treating interest rates like the weather, something you just have to endure, and start treating them like an engineering problem. We are going to talk about the art of immunization.
Immunization is the perfect word for it. It's very medical. You're basically injecting a vaccine into your portfolio so that when the virus of rising rates hits, you don't get sick.
But we aren't just going to read the textbook definitions today. I want to actually build the vaccine. I want us to construct a professional-grade hedge, from scratch. We're going to take that hypothetical $100 million portfolio, and we are going to calculate exactly down to the single contract how to neutralize its risk using a metric called DV01.
The dollar value of an O1, that's the language of the trading floor. It's the mechanics wrench.
And we're going to design a strategy that creates a theoretical perfect shield against these rate shifts. And to help us visualize this, I want to introduce a concept right now that we're going to build toward. I want us to imagine we are building a report for your chief risk officer. Let's call it the redesign table.
I like that. Most risk reports are they're unreadable spreadsheets.
This one is going to be different. It's going to have 4 simple columns. Column 1 is your asset, column 2 is your hedge, column 3 is your net risk, and column 4 is the gotcha column. The risk that's left over when you think you're totally safe. By the end of this dive, we are going to fill in every single cell of that table.
That's a tall order, but it's really the only way to understand how the machine works. You have to take it apart piece by piece.
So let's start at the very, very beginning. Before we can buy insurance and before we can start trading futures or doing any kind of calculus, don't we need to agree on something really basic? Don't we need to agree on what time it is?
You would think so. I mean, time seems like a universal constant, right? A year is a year, a day is a day.
That's what I thought. I just assumed a year is 365 days, maybe 366 in a leap year. But as I was digging into this, I realized that in the bond market, time is a surprisingly slippery concept. It's almost elastic.
It is. This is the first hurdle that trips up every junior analyst on their first day. We call it day count conventions. If you're trying to calculate the interest on a bond or the price of a future, you have to know which ruler the market is using to measure time. And the thing is, there isn't just one ruler.
There are 3 main ones, right? And they all give you different answers.
Drastically different. And we should probably walk through them because if you get this wrong, your hedge is just going to be sloppy from the start. You can't hedge a precision instrument if you're measuring time with the wrong ruler.
Okay, ruler number 1. Let's talk about the Treasury market. This is the U.S. government.
Right. So Treasury bonds use a convention, called actual. And this is the logical one. It's the one that makes intuitive sense to you and me.
Actual just means you count the actual number of days between payments and then divide it by the actual number of days in the year.
Exactly. If the coupon period is, say, from January 1st to July 1st, you literally count the calendar days. Let's say it's 181 days in a non-leap year, and you divide that by 365. It's precise. It is the gold standard because, well, the U.S. government has the computing power to be precise, and more importantly, they don't have a profit motive to skim pennies off the top.
Okay, that makes perfect sense.
Right.
But then we move to corporate bonds and municipal bonds. You know, the stuff in our $100 million portfolio, they don't use they use something that sounds like it's from, I don't know, the Twilight Zone, 3360.
3360. And this is a relic. It's a fossil. You have to imagine a world before Excel. Imagine you're a clerk in a bank in, say, 1920. You're wearing a visor. You have a stack of 1,000 bonds on your desk, and you have to calculate the accrued interest for a client who's selling a bond on, let's say, February 14th.
And I've got to do it by hand.
All by hand. Now, you have to try and figure out, is it a leap year? Does February have 28 or 29 days? Did I remember that? 30 days, half September? Rhymed correctly. It's just a nightmare. It's incredibly prone to human error.
Right.
So the market simply agreed on a fiction. They said, look, to make the math easier for everyone, let's just pretend that every single month has 30 days. And let's pretend the year has 360 days.
So January has 30 days. February has 30 days.
Correct. Even if you hold the bond through the 31st of January, you only accrue 30 days of interest. It's purely a simplification.
And does it make that big of a difference?
Over a short period? No, not really. But if you're calculating yields to the 5th decimal point on a billion-dollar portfolio, then yes, it absolutely matters. But the real distortion that comes with the third ruler, this is the one that always makes people a little angry when they realize how it works, the money market.
And this is T-bills, commercial paper, and historically, things like LIBOR, all the short-term lending.
Exactly. And they use a convention called actual 360.
Wait, walk me through the math on that. Actual divided by 360. What does that mean?
So the numerator, the top number, is the actual number of days you hold the loan. Let's say you lend me money for a full year. That's 365 days. So I have to pay you interest for 365 days.
Okay, that seems fair.
But when we calculate the rate of interest per day, we divide the annual rate by 360.
Oh, I see it. You're charging me for 365 days of interest, but your divisor is only 360. You're dividing by a smaller number.
Which makes the result bigger.
So the lender gets more money.
Precisely. It's called the banker's year. It increases the effective interest rate by roughly 172nd. It sounds tiny, right? But think about the global money markets. We're talking trillions of dollars of swaps and short-term loans. That little math error transfers billions of dollars from borrowers to lenders every single year.
Wow. That's essentially a hidden fee encoded right into the counter.
It is. And for our purposes, for building this hedge, it means you have to be hyper-aware. If you're hedging a corporate bond, which thinks a year is 360 days, using a treasury instrument that uses a different calendar, you're comparing apples and oranges. You have to convert them to a common language, or your net risk column in our table is going to be wrong before we even start.
So, step one of the mission. Check your ruler. Don't ever assume you know what 1 year actually means. Okay, so we've got the time sorted out. Now we need the tools. If we're going to fight this invisible thief, we're going to need some weapons. And in the financial world, the heavy artillery is the futures market.
Specifically, for the long end of the curve, it's all about treasury bond futures.
Now, I've traded stocks. I know that if I buy a share of Apple, I get a share of Apple. It's a specific, tangible thing. I just assumed a treasury bond future was the same, a contract to buy a specific 30-year bond. But you're telling me it's not that simple.
No, it's actually much more interesting than that. Imagine if the futures contract forced you to deliver one specific bond, say the treasury bond, maturing on August 15th, 2050. What happens if a big hedge fund goes out and buys up 90% of those specific bonds?
They corner the market.
Exactly. They own the entire supply.
Yeah.
Now, everyone who is short the futures contract, so everyone who promised to deliver that bond, is in a complete panic. They have to buy it to fulfill their contract, but the hedge fund refuses to sell. The price goes to infinity. It's a classic squeeze.
So how do the exchanges prevent that from happening?
They create a basket. So when you sell a treasury bond future, you aren't promising to deliver one specific bond. You're promising to deliver any bond that fits a certain set of criteria. For the classic T-bond contract, it usually has to be a bond with at least 15 years remaining until it matures.
Okay, so I'm the seller. I have a short position. The contract expires, and now I have to hand over some bonds to you. I look at this basket, and there might be 20 different bonds that all qualify. Which one am I going to give you?
Well, you're going to be rational. You're basically a grocery shopper who has been contracted to deliver 1 dozen eggs. The contract doesn't say organic, free-range, omega-3 eggs. It just says eggs. Are you going to go buy the $8 carton?
No way. I'm going to buy the cheapest eggs I can find that aren't already cracked.
Exactly. And in the bond market, you're going to scour all the available bonds, calculate which one costs you the least to acquire relative to what the futures contract pays you for it, and you will deliver that one. We call this the cheapest to deliver bond, or the CTD.
And this is critical. I want our listeners to really get this. The price of the futures contract that you see on your screen. It's not tracking the average of the market. It's not tracking the best bond.
No.
It is tracking that scrunched up carton of cheap eggs.
That is the anchor. The futures price tracks the CTD bond. And here is where the gotcha comes in for the amateur hedger. That CTD bond, it changes.
So the cheapest bond today might not be the cheapest bond next month.
Right. As yields move up and down, different bonds with different coupons and maturities become cheaper or more expensive relative to each other. So if you build your hedge assuming the CTD is bond A, and then suddenly the market shifts and the CTD becomes bond B, your whole hedge ratio is now wrong. You're basically hedging a ghost.
We'll get into the math of that later, but I want to talk about one of the coolest loopholes I found. It's called the wild card play. It honestly sounds like something from a heist movie.
It feels a bit like one when it happens. It's a true arbitrage opportunity that arises because of a disconnect in time.
We're back to time again.
It always comes back to time. So the Treasury bond futures market on the Chicago Board of Trade, it closes at 2:000 p.m. Central Time. The closing price, the settlement price, is fixed at that exact moment.
Okay, so the price is locked in at 2:0 p.m.
But the cash bond market, where you actually buy and sell the physical government bonds, that doesn't close at 2:0 p.m. It keeps trading until 4:0 p.m. or even later.
I think I see where this is going.
Okay, so imagine you are short the futures contract. You have the right to deliver bonds at that fixed 2:00 p.m. price. Now, let's say at 2:05 p.m., just 5 minutes after the futures market closes, some terrible news breaks. The Fed announces a surprise rate hike or something.
Chaos. Bond prices in the cash market are going to crash.
Exactly. The bonds in the cash market are suddenly, say, 2% cheaper than they were just 5 minutes ago. But your futures invoice price is still locked at that higher 2:00 p.m. level.
So I can buy the bonds in the cash market at the new crashed price.
And immediately announce to the exchange, I am making delivery. And you deliver those cheap bonds you just bought at the expensive 2:00 p.m. price. You pocket the difference. That is the wild card play.
It's essentially a free option. If the market crashes after 2:00 p.m., I win. If it doesn't, I just do nothing.
And because the professional traders know this option exists, the futures contract actually trades at a slightly lower price than the pure math would suggest. The market charges a tiny premium for the risk of being wildcarded. It's one of those structural features of the market that you just don't see in textbooks.
That is fascinating. It's those little mechanical details that really separate the theory from the practice. Now, we've talked about treasury bonds, which are the main tool for hedging long-term risk. But what if our risk is short-term? What if I'm that bank manager who needs to fund operations next month? I don't care about the 30-year bond.
Then you leave the world of treasuries and you enter the world of Eurodollars.
And we have to be really careful with the name here. When I hear Eurodollar, my brain immediately thinks of the euro currency. You know, the money they use in France and Germany.
That's a very common mistake. It has absolutely nothing to do with the euro currency. A eurodollar is simply a U.S. dollar that's been deposited in a bank outside the United States.
So it could be in London?
It could be in London, Tokyo, the Cayman Islands, it doesn't matter. The key is that because it's outside the U.S., it is outside the direct jurisdiction of the Federal Reserve. It's not subject to U.S. reserve requirements.
So it's the pure distilled cost of dollar funding for global banks.
Exactly. And the futures on these Eurodollar futures are probably the most important single contract in the world for the banking system. This is how banks hedge their interest rate risk.
How does the pricing on that work? It's not like a bond price, is it?
No. It uses a really clever index system to make it user-friendly. The quote is simply 100 minus the interest rate.
So if the interest rate is, say, 3.5%, the futures price is 96.50.
Correct. 100 minus 3.5 is 96.50. Simple as that.
And why do they do that inverse thing? Why not just quote the rate?
To make it behave like a normal asset, traders like to buy low and sell high. So if interest rates go down, which is usually good for a portfolio, the price of the future goes up. If rates go from 3.5% down to 3.0%, the price goes from 96.50 up to 97.0. You bought at 96.50, you sold at 97.00, you made money. It just aligns the directional intuition of the trade.
Got it. And we need to know the tick value. This is the smallest possible movement. If that price moves 1 basis point to 0.01, how much money actually changes hands?
So the standard contract represents a theoretical $1 million deposit for 3 months.
Okay. So we can do the math. You have $1 million principal. You multiply that by 1 basis point, which is 0.00001. And you multiply that by the time period, which is a quarter of a year, so 0.25.
1 million times 0.00001 is 100. Times 0.25 is 25.
$25. Every tick is $25 per contract. It's a nice round number. If you're long 1,000 contracts and the market moves up 10 ticks, that's $250,000 in your account.
Now, there is one technical wrinkle with Eurodollars that I really struggled with. We got a critique from some of our advanced listeners that we sometimes gloss over the difference between a future and a forward. They mentioned something called the convexity adjustment.
Ah, yes. Okay. This is where the rubber really meets the road. A forward rate agreement, or an FRA, is simple. We agree on a rate today for a loan in the future. At the end of the period, we settle up. One payment. Done.
Okay.
But a futures contract is mark-to-market daily.
Meaning every single day at the close of trading, cash moves in or out of my margin account. Exactly. And that daily cash flow creates a very subtle but powerful difference. Imagine you are short Eurodollar futures. You're hedging against rising rates.
Right.
Rates go up. You make money on your short. That cash hits your account today.
Okay, so I have the cash now. What can I do with it?
Well, you can buy lunch, or more likely, you can invest it. And since rates just went up, you can invest it at a higher interest rate. You are making interest on your profits.
I see.
Now flip it. Suppose you're losing money, rates go down, you have to pay margin, but since rates are lower, the cost of borrowing that money to pay the margin call is cheaper.
So no matter what, the futures contract is strictly better for me. If I win, I get to reinvest at high rates. If I lose, I can finance my losses at low rates.
Exactly. It has this built-in advantage compared to the forward contract where you just have to wait until the end. And because of this advantage, the futures rate is systematically higher than the forward rate. That gap, that's the convexity adjustment. If you're building a model for a 5-year hedge and you treat the future like a forward, ignoring this daily compounding effect, you will overprice the hedge. You'll be off by basis points, which can equal millions of dollars.
So, okay, let's recap the toolkit. We have the rulers, the day counts really matter, we have the T-bond futures, and we have to beware the basket and the wild card. And we have Eurodollars, where that daily cash flow actually changes the math.
Right.
Now, we need a metric. We need a way to measure the risk that we're trying to kill. Everyone talked about duration. What's the duration of your portfolio? Oh, it's 5 years. But I have a problem with duration.
What's your beef with duration?
It's a percentage. Modified duration tells me that if rates move 1%, my portfolio moves, say, 5%. And that's great, but I can't pay my rent with percentages. I need to know dollars. I need to know if the Fed speaks tomorrow, how much cash do I actually lose?
You are sounding like a true trader now. Duration is an academic measure. It's beautiful, it's elegant, but it's abstract. On the desk, we use DV01.
Dollar value of an O1.
It does exactly what you want. It converts that abstract percentage into a concrete dollar amount. DV01 answers the question. If interest rates move by exactly 1 basis point 101, how many dollars does the value of my portfolio change by?
And the formula for that. Is it complicated?
No, it's surprisingly simple. You just take the price of the asset, you multiply it by the modified duration, and you multiply that by 0.0001, which is just 1 basis point.
Price times duration times 0.0001.
That's it. And the reason this is so much better than simple duration is that it allows for what we call bond algebra. You can't just add the duration of a 2-year bond to the duration of a 30-year bond. That's a meaningless calculation.
Right.
But you can add the DV01 of a 2-year bond to the DV01 of a 30-year bond. Because they're both just dollar amounts of risk. You can sum them all up to get the total risk of your entire portfolio.
Okay, this is it. We have the ruler, we have the tools, and now we have the metric. It is time to build our redesign table.
Let's do it.
So let's go back to our scenario.
Right.
You are the manager. Your asset is a corporate bond portfolio. The value is $100 million. And its modified duration, let's say it's 5.0 years.
Right.
We wanted to immunize this against a rate hike. So step 1, calculate the portfolio DV01. Let's fill in column 1.
Okay, let's do the mental math. $100 million, that's the value, times 5.0, the duration. That gives you 500 million.
500 million.
You multiply that by 1 basis point, which is 0.00001. That just means you move the decimal 4 places to the left, so 500 million becomes $50,000.
50,000. So column 1 of our table reads asset, corporate portfolio, DV01, NAD is $50,000. And it's negative because if rates go up, we lose money.
Correct. That is your leak. Every single time the market ticks up by 1 basis point, $50,000 drains out of your account. If rates move 100 basis points, that's a 1% move, you lose $5 million. We need to plug that leak.
Okay, step 2, analyze the hedge. We're going to use the Ultra T-bond futures. Let's say the price on the screen is 140.00.
Right.
So that means the contract, which has a face value of 100,000, has a market value of $140,000. Now here's the critical question. What duration do I use for the future? Do I just use the duration of a generic 30-year bond?
Absolutely not. Remember our grocery store analogy. You have to use the duration of the cheapest to deliver bond. That is the specific bond that's driving the price. So let's just assume we've done our homework, we've identified the CTD bond, and its duration is 14.0 years.
Okay, and I want to just pause and notice the mismatch there.
Yeah.
My portfolio has a duration of 5. The hedge has a duration of 14. They're totally different animals.
It doesn't matter. DV01 is the great equalizer. Let's calculate the DV01 of one single futures contract. So the price is $140,000. The duration is 14.0, and 1 basis point is 0.0001.
Okay, $140,000 times 14 is 1,960,000, and then times 0.0001, move the decimal, gives us $196.
$196. So here's the situation. You have a leak of $50,000. That's your portfolio risk.
Right.
And you have a patch that covers $196. That's one futures contract. So how many patches do you need?
It's just simple division. $50,000 divided by $196. My calculator says 255 point narrow.
And you can't trade 0.1 contracts, so we have to round. Let's just round down to 255. So the strategy is this. We go to the market and we sell 255 Ultra T-bond futures contracts.
And I want to pause on the word sell. Why are we selling? Why not buying?
Think about it like a seesaw. If interest rates rise, your bonds lose money. That's bad. But if interest rates rise, the price of bond futures falls. Since you sold them or shorted them, you make money when the price falls. That's good. You want the good from the hedge to exactly cancel out the bad from your portfolio.
Got it. Okay, let's fill in column 2 and column 3 of our redesign table. Column 2, the hedge. Short 255 futures. And the DV01 is 255 contracts times that $196 per contract, which equals plus $49,980.
And it's positive because the short position profits when rates rise.
Exactly. Which brings us to column 3, the net position. You take the negative 50,000 from the portfolio, add the positive 49,980 from the hedge, and you get negative $20.
Look at that number, negative $20. You started with a risk of losing $50,000 every time the market twitched, and you have reduced that risk to the price of a sandwich.
Wow.
That is immunization. You have, at least theoretically, neutralized the threat.
Theoretically. And this brings us to column 4, the column that the textbooks usually just ignore, but it's the one that gets people fired. Residual risk. We reduce the DV01 to near zero. But are we actually safe?
You're safer, but you are not safe. You have locked the front door, but you left the back window wide open. There are 2 ghosts haunting this table. The first one is basis risk.
Okay.
Look at your assets. You own corporate bonds. Now look at your hedge. You sold treasury futures.
So they usually move together, right?
Usually. But what happens in a financial crisis? Investors panic. They sell their risky assets like corporates, and they buy safe assets like treasuries.
Oh, no.
So corporate yields go UP, which means their prices crash, but treasury yields go down N, which means their prices soar.
That is the absolute worst case scenario. My corporate portfolio crashes because yields went up, but my hedge, I'm short treasuries if treasury prices soar.
You lose on the hedge, too. You lose on the portfolio, and you lose on the hedge. The basis, which is the spread between corporates and treasuries, widened against you. Your perfect mathematical hedge didn't just fail. It actually doubled your losses.
So DV01 hedging only works if the correlation between the asset and the hedge stays constant. If that correlation breaks, the whole math just falls apart. What's the second ghost?
Curve risk. Our calculation assumed what we call a parallel shift. We assumed that if the 5-year rate where your portfolio is moves up 10 basis points, then the 14-year rate where your hedge is also moves up 10 basis points.
But the yield curve twists. It flattens, it steepens.
Exactly. The yield curve is like a snake. The head can move up while the tail moves down. So if short-term rates skyrocket, crushing your 5-year portfolio, but long-term rates stay flat, meaning your hedge doesn't make any money, you were completely exposed. You thought you were immunized, but you were only immunized against a straight line.
It's actually terrifying to realize that even with the perfect math, you're still making a bet. You're betting that these historical correlations will hold. I want to talk about how this falls apart in the real world with a famous example. We got a lot of requests to discuss the Mittelgesellschaft disaster. This is sort of the classic case study of hedging gone wrong, isn't it?
It is the Titanic of hedging stories. It's a huge cautionary tale. So Mittelgesellschaft, or MG, was a big German conglomerate. And in the early 90s, they had what seemed like a brilliant idea. They sold long-term contracts to deliver oil to their customers at fixed prices for 5 to 10 years out.
Okay, so they had a massive short position in oil. They owed oil in the future. If oil prices went way up, they would lose billions.
Yeah.
They obviously needed to hedge.
Right. They needed to buy oil futures to hedge that risk. But here was the problem. There's no liquidity in 10-year oil futures. You can't just go and buy the 2003 oil future back in 1993.
Right.
Nobody trades it.
So they had to use that strategy we hinted at earlier, stack and roll.
Correct. They calculated their total risk. Let's just say they needed to hedge 100 million barrels of oil. Instead of buying long-term contracts that didn't exist, they bought 100 million barrels worth of short-term futures. The front-month contract, the really liquid stuff.
And the logic there was, if oil prices go up, the short-term price will also go up, and they'll make money on the hedge to offset their long-term loss.
And every month, as those front-month contracts expired, they would just roll them. They'd sell the expiring ones and buy the next month out, mathematically. It looked like the DV01 was matched. The risk was covered. But then the curve shifted. The oil market went into what's called contango, which just means that short-term prices were cheaper than long-term prices.
And so every time they rolled their position,
They were selling cheap and buying expensive. They were just bleeding cash on the roll. But the real killer was the cash flow. Oil prices dropped. Now, their long-term contracts, the liability, they became very valuable on paper. They were winning in the long run. But their short-term hedge, their long futures position, was losing massive amounts of money today.
and futures are settled daily. Margin calls.
Exactly. The exchange called them up and said, we need $100 million in margin now. Okay, now we need another $200 million now. Mittelgesellschaft had this huge profit on paper in the distant future, but they had a catastrophic cash hemorrhage in the present. They couldn't meet the margin calls. The board panicked. They liquidated the entire hedge right at the bottom. The company lost over $1 billion.
That is the ultimate lesson. You can get the DV01 exactly right, but if you get the cash flow wrong, if you ignore that liquidity trap, you still die.
That's it.
So we've built the table, we've seen the ghosts. I want to briefly touch on one more practical adjustment. We mentioned tailing the hedge in the outline. This connects right back to that Mittelgesellschaft cash flow issue.
It does. Tailing is a technique to adjust your hedge ratio to account for the interest on the margin cash. We calculated 255 contracts for our bond portfolio. But if we expect rates to rise, we expect to make cash on our short hedge. And that cash can earn interest.
Right.
That interest is extra protection. So technically, we don't need a full 255 contracts. We might only need 254 or 253.
Because the interest we earn on our profits does some of the work for us.
Exactly. The formula is basically your standard ratio times the spot price divided by the futures price. And since the spot price is usually a little lower than the futures price due to carry costs, this ratio is slightly less than 1. It shrinks your hedge just a tiny bit. It's a fine-tuning knob. On 100 million, it saves you the transaction costs of a few contracts, but it shows you understand the deep mechanics of money.
Okay, we are in the home stretch here. We have covered a massive amount of ground. Day counts, the basket of delivery, the wildcard play, convexity adjustments, the DV01 calculation, the tragedy of stack and roll. But I want to end on maybe a more philosophical note.
Okay.
We spent this entire hour trying to get column 3, the net risk, down to 0. We wanted to neutralize the thief completely. But let me ask you, if I successfully hedge away all of my risk, what have I actually done?
That is the great paradox of hedging. Risk and return are joined at the hip. You can't have one without the other. If you take a corporate bond portfolio that's yielding 6% and you perfectly hedge away all the duration risk, you haven't created a magic money machine.
Mhm.
You've essentially converted that corporate bond into a synthetic treasury bill.
You've stripped out the risk.
And so the market will strip out your return. You'll be left earning the risk-free rate plus maybe a tiny credit spread.
So the goal of the portfolio manager isn't necessarily to hit zero in that net risk column.
No. The goal is targeted risk. Maybe you think rates will rise, but you think they won't rise as much as the market thinks. So you don't hedge 100% of the DV01. Maybe you only hedge 50%. You leave yourself with a net DV01 of negative 25,000 instead of negative 50,000. You're underhedged. You are taking a specific, calculated view.
So the hedge isn't a straitjacket, it's a control panel, a set of dials.
Exactly. It turns investing from gambling, where you just take whatever the market gives you, into engineering, where you decide exactly how much heat you want to feel. That table we built allows you to make that decision with your eyes wide open.
And that is the true deep dive. It's not about memorizing formulas. It's about understanding the mechanics so you can be the architect of your own risk. So, to all our listeners, go build your own redesigned table. Check your day counts. Watch out for that basis risk ghost. And always remember, the goal isn't to avoid risk. The goal is to choose the risk you want to keep.
Well said.
Keep calculating, keep questioning, and we will see you on the next deep dive.